Welcome back to the deep dive. It is Tuesday, February 10th, 2026, and today we are doing something a little different.
Yeah, this isn't our usual kind of thing.
We're not just looking at an earnings beat or, a new product launch. We are looking at what is effectively a treasure map.
It really does feel that way. I mean, usually when we analyze a company, we are digging through the trash looking for clues, right? A footnote in a 10K, some vague comment on an earnings call.
You're a detective.
We're detectives trying to solve a puzzle the company doesn't even want solved.
Right. But today, we basically have the answer key. We are breaking down this exclusive, almost hour-long interview with Anthony Noto, the CEO of SOFI.
And the source material we have in front of us is literally titled The Noto Blueprint, SOFI's Path to $40.
Which, let's be honest, CEO interviews are usually just fluff. It's all, we're excited about the future and our team is executing well.
This is not that. This is, well, it's surprisingly specific. Noto isn't giving a pep talk. He's giving us the math. He is laying out a very specific quantitative roadmap for how the stock doubles from where it is today.
Which is hovering around $20.
Yeah, from $20 to $40.
And the timeline isn't someday. The context here is so important. We're in early 2026, and this blueprint, it suggests that Wall Street is completely asleep at the wheel about 3 massive shifts that are happening this year.
Exactly. The whole premise is that the market is valuing SOFI based on what it was, a consumer lender, and just totally ignoring what it's becoming.
So our mission for this deep dive is to decode this blueprint. We need to figure out if this pivot from a risky lender to stable giant is actually viable, or if it's just corporate speak.
And we have to talk about the crypto disguised as a bank claim.
Oh, we do. That sounds like a headline from 2021, not 2026. And most importantly, I want to grill you on the math, because Noto is claiming a valuation multiple that puts him in the same league as a high-flying tech stock, and I am not sure I buy it yet.
That's the right kind of skepticism. Let's get into it.
Okay, so let's start with this identity crisis, or as they call it, the pivot. I mean, if you stopped a random person on the street in, say, 2024 and asked, what is SOFI? What would they say?
Student loans.
Student loans. Or maybe the stadium where the Rams play.
Right. The old SOFI was defined by consumer debt, personal loans, student loan refinancing. And look, they were objectively good at it. They built a huge machine.
But the problem with consumer debt, and anyone who follows the macro cycle knows this, is that it is terrifyingly cyclical.
It's great when rates are low and everyone has a job.
But when the economy turns.
Exactly. When the economy turns or rates spike, defaults tick up. And investors hate that kind of uncertainty. You wake up every morning wondering if your customers can pay you back.
So the new SOFI strategy for 2026 is moving away from that anxiety. The blueprint calls it big business banking.
It does.
But hold on. Big business banking. That puts them in the ring with JP Morgan, with Citi, with Bank of America. You're telling me SOFI, this app on my phone, is going to steal lunch from Jamie Dimon.
Not exactly stealing his lunch. Maybe.
Yeah.
Maybe stealing his plumbing.
His plumbing.
Yeah, we are talking about lending money to businesses. We're talking about the operational side. Treasury management.
Treasury management. Okay, explain that to me like I'm 5, because that sounds like the most boring topic we could possibly cover.
It is incredibly boring.
Yep.
And that is exactly why it's the holy grail of fintech.
Okay.
So think about a massive corporation, a Fortune 500 company. They move millions, sometimes billions of dollars around every single day, paying suppliers, making payroll, managing cash flow across borders.
Sure.
All that money has to move through specific rails, wires, ACH, real-time payments. And every time that money moves, a tiny fee gets collected. It's a toll booth.
Okay, I get the toll booth analogy. I mean, Visa and MasterCard do that for consumers.
Precisely. But here is why treasury management is the killer app for 2026. It's sticky. I mean, if you have a personal checking account, you can switch banks in an afternoon. It's annoying, but you can do it.
I've done it. It's a huge pain, but yes.
Now, imagine you're a multinational corporation. You've got integrated accounting software, thousands of vendors, complex payroll systems, all tied to your bank's API. You can't just switch banks on a Tuesday.
No way.
It takes months, sometimes years, to migrate all that infrastructure. So once a bank gets that business, they have that customer for life.
So it's a moat?
It's a massive moat with alligators in it.
Yeah.
And the revenue is fee-based, not interest-based. It doesn't matter if the economy crashes or interest rates go to zero, companies still have to move money.
So Noto's goal, and this is explicit in the blueprint, is to stop looking like a risky lender and start looking like a stable, fee-collecting giant.
He wants the market to view his revenue the same way they view Visa's revenue.
Hmm.
A dollar of lending profit is seen as low quality because it's risky. But a dollar of transaction fee profit is high quality because it's recurring and it's safe. If SoFi pulls this off in 2026, the entire quality of their earnings changes, and that usually leads to a much higher stock price.
Okay, I see the logic there. But this brings us to this weird contradiction in the source material. We just spent 5 minutes talking about how they want to be a boring, stable, fee-collecting bank. But then Noto drops this line, "We are a crypto company disguised as a bank."
That was the line that jumped out at me, too.
How?
It's a weird thing to say.
It feels completely contradictory. We're super safe and boring. Also, we are a crypto company. Is he just throwing buzzwords out there to get the retail investors excited?
I don't think so. You have to look at how they're doing the boring stuff. To be a competitive treasury management player in 2026, you can't run on the old rails.
What do you mean?
The legacy banks, the JP Morgans of the world, they are running on code written in like the 1970s. It's slow, it's expensive, and it breaks all the time.
It takes 3 days for a wire to clear. I know that pain.
Exactly. So what SoFi is doing is building SoFi Pay and launching their own stablecoin. Now, forget the speculation part of crypto. Don't think about Bitcoin going to the moon. Think about blockchain as a settlement layer.
So using the tech to move the money, not necessarily speculating on the asset itself.
Right. If SoFi can move $1 billion for a client instantly, 247, for a fraction of the cost of a traditional wire, because they're using blockchain rails on the back end, that is a massive competitive advantage.
So the client just sees money sent. They don't even know it was a stablecoin transaction on a blockchain.
The client doesn't care how the sausage is made, they just want it to be instant and cheap. But for you, the investor, this distinction is everything. And this leads us right into the valuation game.
The multiples.
The multiples. Banks trade at 10x earnings. Tech platforms, they trade at 30x or 40x. If Noto can convince the world that his boring bank is actually running on exciting tech, he thinks he can unlock that higher multiple.
Which is a perfect segue to the numbers, because this is where I need you to be the voice of reason. The source material outlines the math to $40. And honestly, when I first read it, it felt like girl math, but for finance bros.
It's definitely aggressive CEO math, no doubt.
So walk us through it, because getting to a $40 share price from 20 implies a 100% gain. In a year where the S&P might do, 8%? He's looking for 100. How?
Okay, so it starts with the growth rates. The source claims SoFi is growing revenue by 30% and earnings by 40%. Now, just pause there for a second.
Okay.
For a bank, those numbers are astronomical. Most banks are happy with 5% growth.
Sure, but again, if they're pivoting to this boring banking, can they actually sustain 40% earnings growth?
That is the billion-dollar question. But let's just assume for a moment the growth is real. Noto uses a metric called the PEG ratio, price earnings to growth.
Can you give us a quick refresher on that?
The PEG ratio just compares the price of the stock to how fast it's growing. A PEG of 1.0 is considered fair value. So if a company is growing earnings at 20%, it should trade at 20x earnings. If it's growing at 10%, it trades at 10x earnings. Simple as that.
Okay, so what PEG is Noto using?
He's using 1.1, and he calls this conservative.
A 1.1 PEG is, it's fair, maybe slightly premium.
Oh.
But here's where the math just gets wild.
Right. He takes that earnings growth rate, which is 40%, and he multiplies it by the PEG ratio of 1.1. And that gives you a price to earnings, a PE multiple of 44x.
44 times.
Whoa.
Okay, stop right there. NVIDIA trades at 44x sometimes. Palantir trades there. You are telling me a bank, even a cool bank, should trade at 44 times earnings. That seems delusional.
It is certainly optimistic, but this is where that whole crypto company disguised as a bank narrative comes back in.
Yeah.
If the market accepts that SoFi is a high-growth tech platform, then 44x is actually reasonable.
But if the market thinks it's just a bank?
If the market thinks it's just a bank, 44x is completely insane.
So the entire bet relies on the market changing its mind about what SoFi is.
Exactly. And if you take that 44x multiple and you apply it to the projected earnings for 2028, the calculator spits out a stock price somewhere between $30 and $40.
So it's a logic chain. If UF growth stays at 40% and the market awards a tech multiple, then the stock hits $40.
Correct. And if either of those links breaks, If growth slows to 15% or if the multiple stays at a bank like 12x, the whole thing falls apart.
Well, clearly the Wall Street analysts covering the stock right now do not believe the math because the stock is sitting at 20 bucks.
Which brings up the most entertaining part of this blueprint. Anthony Noto is not happy with the analysts.
Not happy is being very diplomatic. He called their models idiotic.
I actually laughed when I read that. CEOs usually say things like, we have a difference of opinion regarding the models. They don't just say these guys are idiots.
It's definitely that founder energy coming through, but there is a structural point he's making here that is actually pretty valid. We have to look at who these analysts are.
Okay, who are they? They're bank analysts. They work for Wells Fargo, JP Morgan, Goldman Sachs. Their entire careers are built on analyzing traditional banks. They have spreadsheets that have worked for 30 years for analyzing Citigroup.
And now they're trying to jam SOFI into that same Citigroup spreadsheet.
Exactly.
Yeah.
It just doesn't fit. The source uses a great analogy. It's like asking a Walmart retail analyst to value Amazon Web Services back in 2012.
They wouldn't even know where to start.
They would look at it and say, why are you spending so much money on servers? You sell books. They literally didn't have the framework to value the cloud business.
So Noto thinks the bank analysts simply don't have the framework to value the tech stack that SOFI has built.
That, plus the obvious conflict of interest, I mean, let's be real, is an analyst at JP Morgan incentivized to write a report saying, hey, this new competitor is faster, better, and cheaper than the bank that pays my salary.
Probably not. It's a fair point. So Noto is basically going to war with them.
Literally. The blueprint mentions that he has deployed an internal team specifically to audit the analysts' models. He's having his team tear apart their assumptions, find the errors, and essentially embarrass them into correcting their price targets.
He's auditing the auditors. That is aggressive.
It is. It shows he isn't just passively waiting for the market to catch up. He is actively trying to force the issue.
Which brings us to the timing. Because all of the strategy is great, but if you're an investor listening to this, you're wondering, what do I do now? And there's a very specific date flagged in this source material, March 1st.
This is the critical action item from the entire interview.
Why March 1st? What's so special about that date?
Because right now, Anthony Noto is handcuffed. He's in a mandatory blackout period. Even though he thinks the analysts are idiots, even though he thinks the stock is half off, he legally cannot buy a single share until that blackout lifts.
And he made it very clear how he feels about that.
He said, and this is a direct quote, if March 1st was last week, I would have been buying.
Wow. That is about as close to a buy signal as a CEO can legally give without getting sued by the SEC.
It really is. He is telegraphing his move. He's basically telling the market, I am sitting on cash, and the second I am allowed to, I'm going to buy.
So the strategy for the listener here, according to the source, is to watch the SEC filings like a hawk in that first week of March.
Yes. The green light scenario is this. The market stays choppy. Maybe the stock drifts sideways or dips a little. Then the blackout lifts, and boom, you see a Form 4 filing showing Noto bought, say, $500,000 or $1 million worth of stock.
That's the validation. That's what confirms he actually believes his own math to $40.
Exactly.
Yeah.
Talk is cheap. Insider buying is expensive. If he put his own money where his mouth is, the thesis is live.
Now, the source material also suggests a specific trading strategy for this period. It mentions selling puts. And I want to be careful here because, we have listeners with different levels of trading experience. We're not giving financial advice. But can you explain the logic of that strategy in this specific context?
Right. So if you believe Noto, then $20 is the floor. He thinks it's cheap here. The selling put strategy is basically a way to get paid for your patience.
Break it down for us.
When you sell a put option at the $20 strike price, you are essentially telling the market, I am willing to buy SOFI shares at $20 no matter what happens.
Which, if you're bullish like Noto, you are happy to do anyway.
Exactly. And for making that promise, the market pays you a cash premium right now. Let's say you get paid $1 per share for that promise.
So I pocket that cash immediately.
Right. Now, two things can happen. Scenario A, the stop shoots up to 25. You miss the ride up, but you keep the cash premium you collected. It's free money.
Not bad. And scenario B.
Scenario B, the stock drops to $19. You are then forced to buy it at $20. But because you collected that $1 premium, your actual cost basis is $19. So you effectively bought the stock at a discount to where it was.
So it's a win-win as long as you actually want to own the stock in the first place.
Correct. The source calls this building a war chest. You're either collecting income or you're acquiring shares of a high-growth company at a discount. It aligns perfectly with Noto's view that the downside is limited because the company is fundamentally undervalued.
It's a sophisticated way to play that floor he's talking about.
It is. It removed the pressure of trying to time the exact bottom.
So let's zoom out and wrap this up. We've looked at the pivot to boring banking. We've looked at the crypto rails. We've crunched the very aggressive math to $40. And we've got a CEO who is chomping at the bit to buy his own stock on March 1st.
It is a very compelling setup.
But I want to leave the listener with a final thought, something to chew on. We talked about this duality, SOFI, wanting to be both the boring corporate treasury bank and the high-flying tech disruptor.
The identity paradox.
Exactly. Can you really be both? I mean, when I think of my safe bank, I don't want them experimenting with crypto. And when I think of my high-growth tech bet, I don't want them bogged down in treasury compliance.
That is the execution risk, 100%.
Is there a danger that by trying to be everything to everyone, they end up being nothing? That the bank investors think it's too risky and the tech investors think it's too boring?
That is absolutely the biggest risk. If they get stuck in the middle, they get what's called the conglomerate discount. They don't get the 44x multiple, they get an 8x multiple because nobody really understands what they are.
So Noto's job isn't just to build the tech, it's to tell the story so clearly that the market have no choice but to give him that tech multiple.
And judging by this interview, he knows that. He is shouting this story from the rooftops. Now he just has to execute.
March 1st, that's the date to watch.
Eyes on the filings.
That's it for this deep dive into the Noto blueprint. We'll see you next time.